So the question today is, how high will interest rates go? Hi, I'm Marissa, Kristin, we're from Rise High, and one of the things that we get asked more than anything else at the moment is what's going on with interest rates and how high will they get? So we thought we'd run a Facebook Live session with you today to talk about interest rates, what's happening with interest rates, some of the predictions coming ahead with what we're expecting to see with interest rates. So I've asked one of our amazing mortgage brokers, Kristin, to help us today to talk through all things interest rates. We are coming to you live, so if you've got any questions that you want us to address with you live today, we'd be happy to have them sent through. As I said before, these are questions that we're getting very often at the moment, so we're going to be addressing all of the frequently asked questions that we're getting right now, and hopefully that helps you to do some planning for yourself. So before we get into it, Kristin, why don't you just give us a bit of background on obviously what's going on with interest rates, what's been happening recently. Obviously it's been a big year for interest rate movements, a lot of unexpected rapid increases. What is going on? Give us the background.
Yeah, so I think if you've got a mortgage, you're probably feeling the pinch at the moment and definitely aware that rates are going up.
Yes.
But what are those things that are influencing those rates increasing? So really, it's two main things. It's inflation and unemployment rates. So we had both of them at historical lows back at the start of the year or late 2021. And really what we were hearing from the Reserve Bank is that they weren't planning on any rate increases until 2024. But unfortunately, us Australians, we partied too hard for too long on really cheap interest rates and kind of that thought of unlimited liquidity. Then we had COVID, the Ukraine conflict, and now Australians are really paying the price for that government policy with one big inflation headache.
Yeah, that's right. And I think obviously, the rate, we always knew that the rates were going to rise because they couldn't stay where they were, and we've positioned that with our clients right from the beginning that rates were at historical low levels. We knew that they were going to rise. What was probably the surprise was how quickly, when they started to rise and how quickly they've been rising. When we look back at previous rate rises historically, it's happened at a much slower pace, hasn't it? This has been quite aggressive. Yeah,
definitely. So the last rate cycle, I guess, increases that we saw were all the way back in 2009. And during that period, we saw rates go up by 1.75% over a 12-month period.
Yeah.
So it did increase, but it didn't hurt quite as much. If we compare that to what's happened, really recently, we've had that same 1.75 increase, but over a 4-month period. So it's going to continue to climb, and I think people are just feeling it that much more.
Yeah, it's been quite an aggressive, rate rise, and we are expecting to see more rate rises moving forward. So what are the expectations, Kristin, that we're seeing? I mean, obviously it'd be nice to have a crystal ball and just to know exactly what's going to happen and when. And of course, the only, we have to wait for the Reserve Bank meetings and they meet monthly. Mm-hmm. But obviously this is a hot topic. A lot of the economists are looking at this saying, where is it going to go? How high is it going to get? What are some of the expectations out there that, what are they looking like at the moment?
Yeah, so I guess how high and how fast they're going to go up is anyone's guess. The bank economists are predicting a cash rate of between about 2.85 and 3.6%, which translate to mortgage rates on your home loan of around that 5.3 to 6.1%.
And that's obviously the rates for your owner-occupied homes. So investors will be looking to pay more than that again, won't they?
Yeah, and interest only, again, an additional premium on top of that. So look, there is a bit of a variance in opinion, but ultimately they're heading up. So just to give you an idea, some of the big banks in terms of what they're predicting, we've got Commonwealth Bank expecting the cash rate to peak at 2.85% by November this year. And if you look at that slightly different to say like Westpac, they're predicting cash rate to head to 3.6%, but not until February next year. So regardless, we're still in for a few more rate rises.
Yeah, I mean, even when you look at those predictions, they're so different. Really, that there's almost a whole % difference between the predictions of the major economists, and so I guess the bottom line is really there that we actually don't know. And I guess it's going to come down to, I heard a speech from the RBA recently where, they were saying that inflation's heading towards 7%, and basically they're just going to do whatever they need to do to get it back down. So until Australians stop spending, it's just going to they're going to tackle it quite aggressively.
Yeah, absolutely.
But what they did say on what I heard was that the rate at which they increase will start to slow down.
Yeah, I guess they're hoping that the changes that they have made in the last 4 months will start to filter through. There's always a bit of a lag, so I guess it's now just maybe waiting a little, seeing what impact those rate rises have, and maybe not increasing, in such big increments or so quickly over the next couple of months. So
maybe we'll get to a point where instead of them increasing 50 basis points at a meeting, they might only increase 25 basis points at a meeting, until they get to that, until they get to the right level. The other thing that I heard that I thought was interesting was that, we should expect the average cash rate to be equivalent to their inflation goal. And that's probably, when they look at an inflation target of around 2 to 3%, so they're saying the average cash rate over the long term needs to be in that 2 to 3, between that 2 to 3%. Because our cash rate's been so low for so long, we almost need the cash rate to get over that 3% mark for a while to have that long-term average within that 2 to 3% band. So that probably sort of hopefully provides some context as to why rates are rising.
Yeah.
Obviously, rising interest rates does have an impact, not only on people that have a mortgage, but also people wanting to get into the market. What sort of advice are you giving to your clients at the moment as to, we might go through each type of person separately. First, we might start with people that currently do have a mortgage. Mm-hmm. What are some of the things that they can do, given that rates have risen already so much and they are expected to continue to rise further? What are some of the things that you're talking them through to help them to manage that period and that process for themselves?
Yeah, so there's definitely a couple of things you can do to, I guess, prepare yourself or manage your money a little better. The first one is definitely doing a budget, understanding where your money is going, if there's areas where you can pull back on. So many people just have no idea what's happening with their money. So doing a bit of a budget, following it, keeping an eye on where your money is going is probably the key thing.
Yeah, that's a really good point. And it is really hard to know where your money goes. One of the things that we can offer as a free value add service is we can actually analyse your bank statements for you and categorise your spending to help you to understand your current spending habits.
Yeah, and I think a lot of internet banking apps do that for you automatically as well. So maybe just having a bit of a play around with your app and understanding where your money's going. A lot of the work and the information's already sitting there for you.
Absolutely, but definitely that is something that we can add as a free value add service as part of our service offerings. So if anyone wants to sit down and understand where their money's going, we would definitely be happy to help with that. What are some of the other things that people can do to manage this process?
Definitely getting in touch with your mortgage broker. So there's a couple of things we can help you with on the mortgage side of things. That is, we can have a chat to your existing bank and put the pressure on to see if we can get you some more competitive rates. A lot of people get a mortgage and then just forget about it for the next 5 or 10 years and don't really think about it. But there's always some room in there for movement with your existing lender. And here at Rise High, that's something we do for all of our clients every 12 months, is a free home loan review just to touch base and see if we can get you a better rate with your existing lender.
Exactly. The other thing as well is to look at whether, there's other lenders offering other deals as well. It's quite a competitive market out there at the moment.
Yeah,
absolutely. So you don't have to just accept what your bank is offering. Speaking to your Rise High mortgage broker can let you know if there's other options out there. Got a few shout outs to Amanda, Amisha, Fernando, Eugene, Sally, Christine, Fiona, Rebecca, Luke. Thanks for joining us, guys. If you have any questions or comments, throw them through in the comment section. We'd love to answer them live here to you today. So we've talked about a few things that you can do to manage through the increased loan repayments if you're a mortgage holder. So one of the things that you mentioned was understand and manage your budget. We also talk about, making sure that you're speaking to your mortgage broker, obviously your Rise High mortgage broker, to make sure that you're on the best deal for you at the moment. Are there any other things that you sort of suggest to your clients that they look at?
Yeah, so one other thing that you can explore is potentially look at fixing in your mortgage. So locking in the rate so that those rate rises aren't going to impact you quite as much. So you can fix in the entire loan, you can split your loan and just have a portion fixed. But I guess it takes off a little bit of that continual pain that we're feeling at the moment, where rates just keep creeping up on us and squeezing our budgets that little bit more.
Yeah, we've got a really good video on comparing the pros and cons of fixed versus variable rates, and we'll put the link to that video in the comments below. But when you're looking at fixed rates, an important thing to note there is that the expected rate rises of the variable rate are already built into that fixed rate. So fixed rates aren't necessarily about outbetting the market. It's more about having that certainty, isn't it?
Stability.
The stability.
So that you can budget very easily. So yeah, look, you are definitely going to be paying a premium to lock your rate in, and you're paying a price for that, I guess, certainty. But it is something that I guess can help you with your budgeting and knowing week in, week out what your repayments are going to be.
Yeah. So speaking of fixed rates, do you think now is a good time to fix? What's your thoughts?
Look, I think it's very much specific to your personal situation.
Yeah.
I'm probably not seeing quite as many people fix in at the moment as what we did, 12 months ago, because the rates were so competitive. But
and fixed rates generally now are more expensive than the variable rates, because they're obviously factoring in expected rate rises.
Yeah, in the future. Yeah, but I think it's really about understanding the pros and cons of each. Like we said, we've got in that previous video, have a quick glance over that. And then I guess it's just about working out where you are, in the life cycle of your mortgage and what suits your current financial situation, having a really good chat to your mortgage broker, and then making an informed decision.
Yeah, awesome. So that's a few tips for current homeowners that have a mortgage. But what about for those that are looking to get into the market, Kristin? Because you wouldn't necessarily think that rising interest rates would impact them, but it does. What are the big ways that it impacts people looking to get into the market?
Yeah, so I guess the key thing is that as the interest rates rise, the amount that you can potentially borrow as your maximum loan size is going to reduce.
Yeah.
So it's really, really important, I think, in the current environment, is to have a good mortgage broker, hopefully a Rise High mortgage broker, to have a pre-approval where you understand how much you can borrow, and being in constant contact with your broker. So if you are looking to purchase something at the absolute maximum of your purchasing power, that you check in with your mortgage broker before you bid at auction, before you put in an offer on a property, because that amount can shift and change as the rates increase. So it's really important.
I think that's a really important point. I don't know that everyone understands why their borrowing capacity actually reduces as interest rates rise. So can you just explain why that happens?
Yeah.
And what the banks look at, and why, if the interest rate's rising, their borrowing capacity is actually reducing?
Yeah,
how does that work?
Absolutely. So when you do get a pre-approval and apply it for a mortgage, you've got your income coming in, and then you have your expenses coming out. So that includes your living expenses, but any other liabilities that you may have in there as well. So servicing your credit cards or your car loan or those personal debts. Then I guess the money that you've got left over at the end of the day is potentially what you can put towards servicing a mortgage. And that amount that you can service is based on an interest rate. So if that interest rate increases, the amount that you've got left over reduces, and the other way around as well.
That's right. And the banks actually have this extra thing called an assessment rate, which is normally a buffer over and above the actual interest rates. So even though you might feel like you can really comfortably afford the interest rates where they are at now, the bank will apply a buffer to make sure that if interest rates go up, which we are expecting that they will, that you'll still be able to afford your repayments. So I guess it's good advice that you've given in terms of people that are wanting to buy. There'll probably be some great buying opportunities moving forward. Not to be put off by the rising interest rates, just to know that this is always what we're expecting. We're always expecting rates to get back up to, around about the 6% mark, which is looking like that's where they'll get to. It's probably happened a bit faster than we were expecting, but no need to panic. Come and speak to us and we'd love to help you to achieve your goals. Thank you so much for joining us today. We hope this has been helpful. We are here to help you through this. We've got your back and we would love to help empower you to achieve your goals regardless of what's happening with interest rates. So please feel free to reach out anytime and we'll be here to help you. And thank you so much. Thanks for joining us. Bye.